All right. Hi there. Happy Friday. As we start to wind down summer and head back to school with the kids. Hard to believe that summer's almost done here. Thought we'd change it up a little bit this weekend, do a TGIF version via video, go through tons of stuff that's relevant in the economy, et cetera, et cetera. We'll try and do it concise. So going to run through a lot, but try and really make it through your time to get through it. So with that, I'm going to jump right in and start to go over. We've seen another really busy week of earnings season here as we get towards the end of it here. We are the S&P 500 companies. We're 430 of the companies through. There's actually only 498 companies. I bet you may or may not have known that of the 500. So pretty well through earnings season. Definitely beat expectations. There was a lot of negative stuff being priced in when the market was near the lows back in June, and at plus 8% earnings growth so far, it's definitely exceeding expectations. It's been a strong revenue growth. The inflation that we're seeing in the economy right now, the Fortune 500 companies are able to pass that in the way to higher prices to the consumer so far, and it's hitting earnings growth. We're seeing margins compress a little bit. A couple of quarters ago, revenue growth was like in the 5-6% range here, and earnings was 12 to 18% growth down here. So a little bit light on revenues, but expanding margins. So it was accelerating this way. This quarter, we're getting a little bit the opposite, right? Where we got plus revenue growth of near 15 and earnings growth a little bit light. So it's just showing us that margins are coming in a little bit. Underneath the surface, couple of call outs. Energy, with crude being over $100 a barrel for really the good portion of the last quarter. Natural gas near record highs. It's been a super strong quarter. We had 77% earnings growth on energy companies, revenue growth on, and then even better to the bottom line, 308% revenue growth. One thing we wanted to point out is if you were to actually strip out energy from the S&P 500, it's about a 3.5–4% weight of the S&P 500. Earnings would be up about 4 instead of 8. So that's how much of an impact earnings from the energy space had this quarter so far. 60% in cyclicals of the S&P 500, okay, is technology, consumer discretionary, communication service, and financial. 60% of the weights of the index. So a lion's share of the market. Is the first time we've seen in a while. They're starting to slip a little bit here. They have not seen earnings growth. All of them, you can see here, had plus revenue growth. But we're starting to see some margin compression, particularly on the consumer discretionary front, with 16% revenue growth and then minus 3% earnings growth. So under the surface, a couple of things that are noteworthy that we could be construed as not great. But overall, in aggregate, anytime you get plus 8% earnings growth, given the backdrop of the market environment and expectations coming in, we call that a win. It's been a very strong earnings quarter. Moving forward, expectations from Wall Street have really not come down. 2021 was $194 earnings to the S&P 500. Estimates this year were 229, now 226. Basically, still expecting 16% for the year earnings growth, which proves to be really healthy. And then going out to next year, 2023 estimates haven't come down too much. They're at 245, which be then another 8.5% growth year over year. So Wall Street strategists, analysts, they're really still optimistic that earnings are going to continue to be able to deliver. So earnings positive still. What does that mean from valuations? On the valuation front, really, if earnings are up the first part of the year and the stock market was down, the first half was 100% multiple contraction. And what we mean by that is when you look at the PE ratio on the S&P 500, it started the year quite high, mid-high 20s here. Really, when the market sold off into the middle of June, we came back and started to trade around 17 times earnings. I put this yellow line here. You can see the 20-year average is right at that 17, 18 price to earnings multiple in the S&P. That's been the average. So we, sold off enough to make the market cheaper from that perspective. And then with this recent rally in the market, multiples have come up a little bit. So the market's gotten a little bit more expensive. It's trading about 19, 20 times current earnings and 17 times next year. So a couple of call outs here. The last time we hit these low averages was the COVID sell-off, which didn't last long with all the fiscal and monetary policy. We had a Fed pivot at the end of 2018, which got the market cheapness to get more expensive again. We had a shallow earnings recession back in 15 and 16. So if we get another shallow earnings recession, if we get a little bit better news on the GDP front, we sold off enough where the market historically got cheap enough to the 17, 18 times. The caveat to that, or the bear case, would be the last pronounced recession we had was really going back to the financial crisis, 2008, 2009, multiple quarters of negative GDP, and the market traded all the way down to this low multiple, to the 13, 10, and all the way down to 8 and 9 multiple. So that wouldn't be good, but it's something that we've got to be cognizant on as far as what could possibly happen. And with that, we're going to move on to what's going on in the economy. Couple of things that are really, it's this battle of the pros and the cons, and we'll walk through a couple of them right now. The first of which is on the manufacturing front. For the first time since COVID, since 2020, we're actually contraction. On the services side of the economy, which is a bigger representative of the U.S. economy, is still on the services side, so that's a good thing, is still an expansion. All of 2021, we pretty well spent in what we call this inflationary boom camp, which was you had plus growth over here and plus inflation over here. The last report that we just got in June, on manufacturing new orders, actually went this way. So it's the first time that actually growth went to below 50. So on this side of this line, is below 50, which is negative and contraction. And then inflation is still pretty high. Prices paid are still up here. So the economy is starting to move on the manufacturing front towards this, which is what we call stagflation, which is slowing growth with plus or elevated inflation. It's not necessarily the best place to be when it comes to equity markets. And again, this is just the manufacturing side. The services side is still positive. The June report was still elevated growth, so still plus growth. And then in the inflation front was still plus. So it's still in the inflationary boom camp, which is positive. So you've got this kind of tug of war of what's going on underneath the surface there. This is a really good microcosm, I thought, to show you just kind of where we've come from on one slide, couple of clicks here, where we come from out of COVID and where we are today. So coming out of COVID, we had an insatiable demand with all the people sitting at home buying stuff. We had unprecedented fiscal and monetary policy intervention. Future new orders on the manufacturing front started to rocket ship. So what happens if you're one of the companies or producers that's making this stuff? Well, you got to hire more people, right? Employment starts to fire off to fulfill those new orders. Therefore, inventories come down, And once inventories come down, oh, by the way, we had a little bit of a supply chain shock, which you will well know and has been documented by now. So delivery times went up. So when delivery times are going up, you got huge insatiable demand, employment's going up, and inventories get drawn down. Well, prices go up. So prices paid went to really the highest point in which we've seen going all the way back to pre-credit crisis in 2008, and it's been pretty high. So fast forward to where are we today? Well, unfortunately, we've started to see the new orders in the manufacturing front again start to roll off. So when that rolls off and inventories are super high, we're a little overbuilt on the inventory front. You don't need to make as much stuff. So we're in what we call contraction on the manufacturing front. When you don't need to make as much, unfortunately, you start to require less employment, less labor. So we've started to see the labor or input on these ISM manufacturing start to come down. So the employment quotient on this is actually in contraction. And then the bottleneck issue. So when you're ordering less, because the inventories are built up, supplier deliveries are starting to come down. That's good. That's going to alleviate this supply chain that we've been seeing. And with that, we should see some alleviation in the price front, which is good. We start to see it down here. So what happens from here? Well, we've got to work through all this inventory that really got built up. Target, Walmart have all said that they've got general merchandising, et cetera, that they've essentially overbought for, and it needs to run itself through the cycle. So we are more than likely to be able to clear this inventory. Going to start to see some prices come in, right? You got to lower prices to clear that, give people an incentive to buy stuff that they might not want at this point. So the price is coming down. If you're a company and your prices are coming down, your margins get squeezed. unfortunately, are more likely to require less labor. Okay, so we could see some claims coming down the road, and then that is kind of a self-fulfilling prophecy. If people get laid off, future new orders actually start to continue to go lower until eventually you get through the inventory glut. You get through that inventory glut. It takes time. It's a process. This is an economic cycle. Once that happens, you can build up, and then we can start the new cycle over, just like we started back here, So I thought this was a cool little snapshot into the window of how a longer term business cycle works and kind of what we saw out of COVID to what we're seeing today. So on the positive front of what we're seeing, employment remains incredibly strong. We just got the non-farm payrolls report today, this morning, actually 5:30. 528,000 jobs were produced, far exceeding expectations, which were about 250,000. The unemployment rate remains incredibly low at 3.5%. And then continuing jobless claims, so the people that are on unemployment benefits, they're really, really low when you compare them to prior recessions. And that's why, we've got this contraction in GDP, but the labor markets continue to be strong, as we've seen this morning with the non-farm payroll. Are the claims creeping up a little bit from the cycle lows? Yeah, but they're really not at a point in time where anything's super negative at this point in time. Point that we're seeing in the credit markets that we don't love, that is a little bit of concern, we're keeping our eyes on, is that high yield spreads, or what we call, are really started to blow out, increase into the volatility that we saw the first half of the year. Since then, we've seen some alleviation. They're back down to 5% above treasuries. So if treasuries are 3% today, you have the spread of this 5% that I'm showing you here. So high yield debt, junk debt is about 8%. We'd really like to see them start to come in more like we did coming out of COVID. This was the COVID spread move up. We're kind of here, we're rotating. So it's in that elevated level that we don't love. It's suggesting that maybe we're not quite through the end of this economic slowdown, and that there's risks a little bit more elevated in the system. Next up is the yield curve, so interest rates. The yield curve inverts not every time you go into a deep recession, but many times it is kind of a forewarning of some negative economic consequences. Today we're at minus 40 basis points, and the yield curve essentially is when the economy is strong, the long end of the curve is a higher rate of return than the front end. So you have 10-year treasuries that would be higher than the front end, or 2 years. Today we're seeing the opposite happen. The Fed is increasing interest rates. They're increasing interest rates here. And then the long end of the curve, the 10-year treasury, is starting to sniff out slower growth. So rates on the 10-year have been modestly coming down from 3.5% to well below 3%, as the 2-year treasury has been coming up. Today, the 2-year treasury is at 3.20, 10-year treasuries in the high 2s. So you've got this inverted yield curve. We just called out the last couple of times that this has happened going into the financial crisis in 08, 09. The slowdown that we saw at the dot-com turn 0001, and then in the late 80s. The late 80s caused a pretty mild recession, didn't hit the stock market too bad. 0002 was a much longer drawn out one, and then the deepest recession we saw was back 08 and 09. So just something that's out there that we're paying attention to that we don't love as well. An example of where we are, we get a lot of questions on Fed tightening, quantitative easing. Thought it'd be cool to give you an example of the 1973, 1974 example of what the Fed was doing. Back then, a little different. Inflation here in 1974 was at 12%. The Fed funds rate, which is what you guys hear us talk about, what the Fed controls, started to really increase the Fed funds rate as inflation started to move. They were a little bit ahead of the curve here, where the Fed funds rate got ahead of where inflation was. In order to kill inflation, to make inflation traverse down the other way, essentially what the Fed does is destruct demand. They want to pull in aggregate demand. If they can pull in an overheated economy, inflation can then pull back. So what often happens when the Fed does this, goes on these tightening, rate rising cycles? This is the same chart I just added, GDP. When you start to really get into the teeth of the tightening cycle, GDP usually languishes. It's just a cross current. Again, the Fed's trying to cool aggregate demand. In this case, it didn't. GDP growth came down and was actually negative for a couple quarters. You had some nice bounces along the way, but just pretty weak for the better part of 1973, 74. And then with that, what's the stock market do? Well, if GDP starts to really sequentially decline and show negative growth, it usually often hits earnings. If it hits earnings like it did back then, the stock market does decline. So that, in a sense, is kind of what we've seen in the past of these a tightening cycle to the extent that we are in right now. So fast forward to today, inflation isn't at that 12% that we saw back in the 70s, but it's at 9%, and it's definitely uncomfortably high for the Fed. The Fed's sitting here at 2.25% to 2.5% Fed funds rate. So what do they have to do? They have to keep raising rates. Markets pricing in them getting from 2.25%, 2.5%, up to 3.5%, 4% by the end of the year or Q1 next year. That's what it suggested. Why? Well, exactly what I showed you. They want CPI inflation to traverse down the other side. With this tightening cycle, what's going on with GDP this time? Well, we just saw sequential negative quarters, minus 1.6 here in Q1. Q2 was minus 0.9%. So like very different. We had a huge economic thrust coming out of COVID. GDP growth that we've really never seen before. Also, precursor, we didn't see it drop as much either going into COVID ever. So two evers, we saw down and then up. And then 2021, we saw GDP firing on all cylinder as inflation started to get a little sticky, started to come up. So the Fed now needs to, let me go back to that slide, sorry, raise rates a little bit more. Why? Because they're going to try and bring inflation. The problem with that is it's more than likely going to kill aggregate demand, which kills GDP. So can GDP bounce up a little bit more from the negative quarters that we just saw? Absolutely. Tightening cycles in history, from when the Fed's doing this, it usually takes about 12 plus months for the actual aggregate demand and that tightening cycle to show in the economic data. So if we're saying that we started this tightening cycle Q1, Q2 of this year, it would be pretty normal for this tightening cycle to start to show in the data in earnest Q1 and Q2 of 2023. So we could see a bounce here in GDP, and it's probably likely going to subside, or it just continues to be weak right away here. So what we're worried about then is it going to hit earnings? We just showed you earnings on the first slide, and it has not yet. So we're paying really close attention to the employment, and we're going to pay really close attention to what's going on in earnings. It hasn't. So in conclusion of what we're seeing right now is that earnings have absolutely exceeded expectations this first quarter, which is great to see. We've got a well-needed bounce in the market. Revenue growth is getting that historical inflation bump and growth balance that corporations have been able to pass off. They've really been able to increase prices, and it has not destroyed demand yet. So we'll see how long they can toe that line. But Q2, positive in that front. We've seen a big bounce in the market this quarter. Fortunately, the market's bounced. That's great. Earnings aren't as bad. It's put it a little bit back more in the more expensive camp on a valuation basis. So we're looking at, basically two paths. One, if earnings can continue to outperform just like we saw this quarter into the end of the year and into 2023, then the market price up here is justified, and we probably got higher to see the stock market go. Counter to that, if earnings start to roll because we start to actually see that demand destruction from inflation and the tightening Fed, margins will come under a little bit of pressure. That just unfortunately means that the market's probably overvalued on this bounce. And longer term speak, what we're really trying to prevent, we're really trying to make sure we're not in, is we want to make sure that we're not in the fall of 2015. We want to make sure that we're not in the spring of 2008. And the reason why that is because those periods of time, we saw the equity markets stage a 10 to 20% rally, and then unfortunately go make new lows later on in the cycle. Some of it was a couple months later, some of it was like a year down the road. We don't have enough information at this point in time. Trying to pick one of those paths. But when we look back throughout history on an economic basis, valuation basis, where we are with the data, more than anything, it just tells us to be patient, that there's going to be time and space required, that we're in a different backdrop to see one of those declines on an economic front market and then just off to the races. the likelihood that we get a V-shaped recovery to new highs can't be ruled out completely. But it's just would probably be a lower probability bet at this point in time. So what are the positives? Well, earnings still remain super firm, which is great. Jobs and employment holding up very well, as we saw this morning with the jobs report. Unlike other recessions, usually at this point in time, if you've seen 2 negative sequential quarters of GDP growth, we would have definitely seen some layoffs, some unemployment claims start to go up, the unemployment rate start to go up. I haven't seen that at all. Labor market is still quite strong. And then the service part of the economy, which makes up or compromises more of the U.S. economy than the manufacturing part, is still in expansion. It has not reached contraction. That's a positive. We mentioned the yield curve being inverted, not a positive sign, something to pay attention to. Credit spreads a little wider than we'd like to see, so just suggesting caution that we're not quite through this. And then, unfortunately, leading economic indicators that we track continue to look like there's going to be weakness in the subsequent quarters coming up. So we've got this really strong bull-bear battle. Got through Q2 earnings season, stronger than expected. Markets bounced, great. Now we need to get this kind of time and space required to work our way through this. So with that. Hope you like the change up of the video presentation this Friday. Have a wonderful weekend, and we will see you bright and dark and early on Monday morning. Catch you later.